Good evening. Hi, everyone, and welcome to the Chicago Economic Society first event of 2015. Thank you so much for braving the elements to be here. We ordered it especially for you. We wanted you to have the full UChicago experience. Miserable weather, brilliant conversation. So thanks for being here. Our program will begin in a minute, but first a few housekeeping matters. Refreshments. The bar will be open until 8 p.m., so feel free to freshen your drink as the conversation goes along. The second thing, technology. Please silence your cell phones, but feel free to live tweet the event. That's our hashtag right there. We encourage your ideas, your reactions to everything that is said here tonight. And the third thing is, please join the conversation. We are available on Facebook, on Twitter. We have a website. We have a Gmail mailing list that you can join to find out about more events. We have a track record of excellent programs, and you're part of that. So please join the conversation. To welcome our speakers and properly introduce the event, tonight we have Kevin Cheng, who's the global founding president of the Chicago Economic Society. So I leave you with him.
Thank you very much, Maria. Happy New Year to all of you. And we're delighted to have you with us tonight. And there's certainly nothing better than to start the new year with old friends, good friends, and a bit of challenging the beautiful snow while learning about jobs, growth, and the state of the US economy from two of the best intellectuals in the world. But before we talk about economics, we would like to talk to you about the first the three groups that organized tonight's event. And the first group is the one that I belong to, which is the Chicago Economic Society, or the CES. In 2012, right here at this conference hall, we founded the CES as the first global economic alumni network for the University of Chicago. The purpose of the CES is to serve as a platform for Chicago alumni and friends to discuss economics and to stay connected to the university. Since our launch in 2012, we have had a number of exciting events right here at IMF. One was the inaugural annual meeting with Professors Gary Becker and Edward Lazier in September 2013. And another one was the second annual meeting with Professor Jim Heckman in September 2014. Beyond Washington, D.C., we have also gone international and have established two chapters in Asia. One is in Hong Kong, inaugurated in September last year by Professor Murphy. Another one is in Singapore, inaugurated by Professor Davis just 3 weeks ago. Another purpose of the CES is to support the outreach efforts of the Becker Friedman Institute for Research in Economics, or the BFI, which is also another organizer behind tonight's event. Professor Kevin Murphy is the director of the BFI, and he can tell you more about the institute after the event. But for now, let me give you a brief introduction of what the BFI is. As many of you know, Chicago economics is known for producing innovative ideas, ideas that not only have shaped the science of economics, but have also changed the world in many important ways. All these ideas come from one core shared belief about economics. And that is the belief that economics is a powerful tool for analyzing the world, the belief that economics is a rigorous science rooted in theory and tested with data. And this is what the BFI represents. Its core mission is to promote rigorous scholarship that has made the work of Milton Friedman, Gary Becker, and Kevin Murphy and Steve Davis so influential and so enduring. And there's more information on BFI at the end of the room, at the table over there. And the third group behind tonight's event is the Booth Alumni Association of Washington, D.C. So now let me turn the podium to Aaron Stopak, who will tell you more about his group. Aaron.
Hi, good evening and welcome everyone. My name is Aaron Stopak, and as president of the Chicago Booth DC Alumni Club, I wanted to first give thanks and a deep appreciation to all of you, the audience, for making the effort and being here tonight to listen to our exemplary panel. I wanted to also thank the IMF, the Chicago Economic Society, the Becker Friedman Institute, and the countless people who put in the hard work and hours into making this event possible, including Kevin Chang and Les Johnson. Finally, I wanted to thank Pedro da Costa for agreeing to moderate, and Professor Murphy and Professor Davis for taking the time from their exhausting schedules to be here tonight. You know, there are only a handful of universities where the name of the school is practically synonymous with excellence in an academic discipline. For example, within a second of mentioning MIT, you think engineering. Stanford, it's computer science. And in the same breath as saying the University of Chicago, you equate it with economics. One of the main reasons for this, that not year after year, but decade after decade after decade, our school has consistently attracted some of the greatest thinkers in the field of economics, like the two distinguished guests we have speaking for us tonight. We learned at Booth how hard it is to both create and maintain a stellar brand. So on behalf of everyone here, I wanted to thank Professor Murphy and Professor Davis for their roles in helping extend Chicago's economic legacy into the 21st century, and for all that they do to keep the flame of economic curiosity burning bright in the students they teach and influence, many of whom are here tonight. So thank you. Thanks.
So now let me introduce someone who inspired and supported us to create the Chicago Economic Society a few years ago right here. And he's the most senior Chicago alum at the IMF. He's Dr. Siddharth Tiwari. Siddharth earned his PhD in economics from the University of Chicago and is currently the Director of Strategy, Policy, and Review Department of the IMF. So now let me give the podium to Siddharth, who introduce the speakers and the moderator. Siddharth.
Okay, I'll be quick because you're waiting for the speakers. I don't need to introduce them. Kevin Murphy has been a star since graduate school. He's the first business professor to get the MacArthur Fellowship. He got the John Bates Clark Award, which is given to the most outstanding economist under 40, though he's no longer under 40. He's worked at the NBER. Your work has been on the economic forces shaping vital social phenomena, such as wage inequality, unemployment, addiction, medical research, economic growth. You have probably been and are a fellow of most elected societies. I think there's only one direction for you to go, and that is Oslo. And I'm sure you'll reach there soon. Stephen Davis is a professor in the business school, deputy dean of the faculty, applied economist with varied publications on employment, wage behavior, wage mobility, job loss, effects of labor market institutions. You're a former editor of the American Economic Journal, Macroeconomics. You have a prolific teaching record at the National University of Singapore, MIT, Hoover Institution, and now Booth. And then finally, our moderator tonight, Pedro da Costa from Brazil. He told me he had a choice between Berkeley and Chicago, and he chose Chicago because of the weather. And I told him he wouldn't have been here had he gone to Berkeley. But with that, please welcome our three panelists tonight, and the floor is yours.
Hi, everyone. Thank you so much for coming. We're just going to start with a couple of brief presentations. One on the state of the labor market and another on the hot topic of inequality, and then we'll continue the discussion from there. And we'll conclude with lots of input from you guys, hopefully. So thanks for coming, and look forward to the discussion.
Thanks for those great introductions and for putting on this event and hosting us. It's a real pleasure to be here. I wanted to put a few facts on the table to supplement what you already know. So I'm assuming everybody in this room is already quite familiar with the fact that U.S. labor markets suffered tremendously in the wake of the global financial crisis, deep recession, what by any standards was a sluggish, disappointing recovery. Things have picked up recently in terms of job growth and a number of other indicators of labor market performance. So I think all of that is well known and is much discussed. I want to put that recent experience and looking forward into a somewhat broader long-term context. Okay, so I'm going to put some facts on the table in that regard. Let me start with employment. Now, what is not as well appreciated as the facts I just talked about is that the employment performance of the U.S. economy has been deteriorating for quite some time, well before the financial crisis and the Great Recession. So I'm going to show you that quickly with a number of charts that look like this one. And what you see on this chart is the employment rate by age at various points in time. And here I'm focusing on men who had some college. So they got beyond high school, but they didn't obtain a four-year degree. And if you look at those lines, they basically drop from one decade to the next. They dropped a lot, especially in the last decade. But the point of this slide, or one point of this slide, is that conditional on age, and in this case for men who have some college education, their employment rates have been deteriorating across most ages for quite some time. Now this chart doesn't break out the before and after the financial crisis. If you do that, what you'll see is that most of the deterioration there from the late 90s to the most recent period occurred since 2007, but there was also some deterioration before then. All right, so that's the kind of picture. Now let me show you the same type of picture, but for 4 different educational groups of men. Okay, and there's a lot in this picture. I'll kind of summarize what the main messages are. Basically, the pattern I just showed you for men with some college holds for men with a college education, for men with a high school education, and for men who didn't complete high school as well. Mainly the intensity of those patterns are different. So the deterioration in employment rates at any given age are greater for less educated men. But even for college educated men, you can see that there's been some deterioration. And the magnitudes that I'm talking about here, especially for less educated men, are enormous. So there's been 10, 20-point drops in the employment rate for some of these age education groups, okay? So that's the story for men. Now, here's the story for women. Same kind of charts, same 4 education categories. The story here for women is more complicated, mainly in that these deteriorations in the employment rate began later, okay? And they're somewhat more muted. But you see the same patterns eventually kicking in for various groups of women, least so for the college-educated women. To summarize what I've shown you so far, if you focus on people of a given age, given educational attainment for men or women, within each of those demographic groups, you see deteriorations in employment outcomes in recent decades. That's been a long-term process for men, and it's one that has begun more recently for women, okay? So that was already going on well before the global financial crisis and the Great Recession. And it says that we had serious problems in the United States labor market well before the financial crisis came along and actually accentuated and worsened those problems. So that's the first thing I want you to absorb. Now, I'm going to put another set of facts on the table briefly that comes out of some of my recent work with John Haltewinger. This is much less known, but I think it's becoming known now, and I certainly want to put this on the table for tonight's discussion. I think it's a related phenomenon, although exactly how closely related is a topic of current research. Here's the second point, the second main point I want you to take away. The fluidity of U.S. labor markets, measured by either the pace at which workers move across employers or by the pace at which job positions are reallocated across employers. using either of those measures of fluidity, they've been on long-term declines. Going back in the case of the job reallocation rate, the pace at which the pace at which job positions are moving across employers, that decline has been in operation since about the early 1980s. That's what you see on the chart, which I guess is on your right, okay? And the pace of worker reallocation, which is a measure of how frequently workers are changing jobs and moving across employers, the decline in that began later, began around 2000, but since then it's been more abrupt. Both of these measures show over the last recent decades a bit more than a 25% drop in fluidity, okay? So I'm not going to show you the evidence here except for one piece, but I do want to say that my co-author and I have established that the patterns you see in this chart here, they are quite pervasive in the U.S. economy. They hold in all 50 U.S. states. They hold in every major one-digit industry. They hold for large firms, small firms, young firms, old firms. Okay, so this is a pervasive phenomenon, this decline in these fluidity measures. Now, I will show you one more chart that gets to the point of the pervasiveness of this phenomenon. This is looking at the same kind of age, education groups for men and women that I showed you before, but instead of looking at employment rate declines, I'm now looking at the pace of worker reallocation, the pace at which workers are being hired and separated from their employers. A lot going on in this chart, so let me just summarize what the key takeaways are. The first one I think is pretty apparent. There are big declines in the fluidity of labor markets according to this measure for every one of these age, education, gender groups. That's point one. Point two, and really points 2 and 3, I'll put them together. The level of this worker reallocation activity is much, much greater for the least educated workers and for the youngest workers. So there's big differences across demographic groups in the levels, but that level is declining for all of these demographic groups. Now, the picture I just showed you raises some obvious questions. One is, why is this happening? And second one is, well, does it matter, and if so, how? So here I've got partial answers for you based on research done so far. First, in terms of why this is going on, you might immediately think that there might be some structural factors in play, and indeed there are. Those can be quantified in a fairly straightforward way, and we've done that. I'll group them into 2 broad categories. There are structural changes on the employer side of the labor market, shifts in the industry distribution of employment, the firm size distribution, and the firm age distribution. If you take all 3 of those together, you can account for about 15% of the decline in job reallocation rates since the early 1980s. And if you recall my earlier charts, the decline in job reallocation is about half, maybe a little bit less than half, of the overall decline in worker reallocation. So there is something there on the structural side, but it's kind of modest. The key thing that's going on there is the shift away from younger business firms and establishments. That's really a major phenomenon in the U.S. economy. It's part of this decline in business dynamism that you may hear about in other contexts, and it intersects with this decline in fluidity that I'm talking about. And it's part of the story, although not the whole story. Now, there have also been structural shifts on the household side, the worker side of the labor market. And here as well, you might immediately be thinking, well, I told you earlier that worker reallocation rates are much, much lower for younger workers. We know that the labor force has been aging basically since around 1980. So you might surmise that part of the decline in the worker reallocation rates is just a consequence of an aging workforce. That is indeed the case. However, most of that effect, in terms of its impact on worker reallocation rates, played out in the 80s and 90s. And the contribution of the aging workforce to the decline in worker reallocation rates is quite modest in the 2000s. We look at this contribution in all 50 states, and it typically accounts for under 10% of this decline in worker reallocation in each state. So to summarize these structural stories, there are structural effects at work, clearly, on both the employer side and the worker side of the labor market, but they only take you a modest way towards explaining these declines in the fluidity measures. And in a sense, that shouldn't be a surprise, because I already mentioned earlier that you see these declines within all of these different sectors on the employer side and demographic groups on the worker side. So yes, there's a role for the structural factors, but it leaves most of the phenomenon unexplained. Now, what else is going on? And here I'm going to be a little bit more, I've got less in the way of solid evidence to quantify, but I've listed some factors here which I feel pretty confident are in play here, although in most cases I'm not yet ready to assign a quantitative magnitude. So I'll mention them very briefly. First, there's been a rather dramatic expansion of occupational licensing restrictions at the state and local government level in the United States really over the last half century. So this is things like getting a license to be a hairdresser. That's a requirement in all 50 states. If you want to be a tree trimmer, you need an occupational license in 5 states. In some states, not very many, but in some you need a license to be a hair shampooer. Not let alone cut the hair, but just to shampoo the hair. Now, in some cases, these licensing restrictions may be justified by pro-efficiency, pro-competitive arguments. But in many cases, I think they arise as incumbent protection devices for people who are already in these sectors. They have the effect of raising wages for the incumbents by restricting entry from others. They impede inter-occupation mobility by design, but of course inter-occupation mobility is one form of mobility of jobs and workers. And so I think they're playing a role in this decline in fluidity I talked about earlier. I can't give you a precise number on that yet. Now, another phenomenon that evolved mainly over the 70s and 80s and early 90s is an erosion of the traditional employment at will doctrine in the common law. And that's the idea, which is no longer, I think, the law of the land in the United States, but once was, that if you were hired by an employer, and unless you had an explicit contract that said otherwise, you were employed at the will of the employer. The employer could release you from the employment relationship just because they wanted to. They didn't have to let you go for cause. Now, what happened in the 70s and 80s, mostly in state court judicial decisions, is that employment at will doctrine began to be eroded. So I'm not going to have time to go into details here, but my work with John Halterwinger provides some direct evidence exploiting the fact that the erosion of the employment at will doctrine occurred at different times in different states and to different extents in different states. You can see how that kind of variation can be used to estimate the impact of the erosion of employment at will on these fluidity measures I talked about earlier, and we do indeed find evidence of that. Okay, now there's more to it than that. There's also been an expansion of protected classes of workers, not through the common law reinterpretation, but through statutes, typically federal statutes, that expand protected classes of workers based on race, age, sex, disability status, health status. The effect of all these things, I think, is to increase litigation risk facing employers when they release workers, if they want to get rid of them, even if they're firing them for cause. The further effect on the incentives of the employers is to be more cautious on the hiring margin. So as a consequence, employers screen ex ante much more intensively than they used to. That may lead to better matches, but it also means it's harder to get your foot in the door if you have a checkered past or you don't have a very strong set of credentials that you bring to the labor market. That is coupled with something else that you've seen a lot of attention to in the newspapers in recent weeks, which is increased ability of employers to screen prospective employees based on their credit history, their criminal background record, their previous encounters with law enforcement, and their personality tests and so on. So the legal regime has shifted in a way that provides greater incentives to screen workers, to screen prospective employees intensively before they get hired. And the information revolution, so to speak, has changed in such a way that it becomes easier and less costly for employers to do that. So I think these are both these two things are in play. Now, is this a cause for concern? It's kind of a mixed picture here. There's definitely some silver linings to these declines in fluidity. Let me mention perhaps the most obvious and maybe the most important. If job reallocation rates decline, that means fewer workers are losing their job because the job disappeared. And fewer workers then flow into the unemployment pool as a consequence of job loss, and there's less frictional unemployment. I've studied exactly that issue in other work a few years ago and found that is indeed an effect that was in play quite significantly. This was a study that looked at the period from the early 1980s to 2005. And I think part of the big declines in the unemployment rate that we had over that period is because of the decline in the job reallocation rate, fewer workers suffering job loss, flowing into the unemployment pool, experiencing frictional unemployment. So that's the plus side of this. But I think there are many downsides to this decline in fluidity. And I think the downsides outweigh the plus sides. So one of the downsides, an obvious one, is if you have lost a job or if you are entering the labor market for the first time or re-entering it, it's harder to find a job. If you have a job right now but you're not very satisfied with it, it's harder to switch to another job. If you need to satisfy a joint location problem with your spouse, that's harder to do in a labor market that is not creating many new job opportunities. If you want to progress along a career path that requires you to switch employers, that becomes harder and harder as the labor market fluidity declines. So I'm not going to go through all the reasons for concern there because I want to keep this presentation short, but I think you can see that there are reasons to be concerned about the impact of labor market fluidity on the ability to find a job, the ability to progress along a career path and get the wage gains that come with that, and the ability to accumulate human capital, not in school, but after school in the process of the labor market, to the extent that that human capital accumulation involves switching jobs in order to advance your skills and career. So here's the fluid labor market hypothesis. This just sets out in a little bit more detail some of what I just said. Let me pass over that quickly. This is a slide that summarizes some statistical evidence in the paper that I've written with Halterwenger that I mentioned earlier. I'm not going to try to go into that detail at this point. Let me just summarize what I think the evidence shows. If you look across the 50 US states and you look within these demographic groups I talked about earlier, what you see is that in the states and in the demographic groups that had larger declines in fluidity, you also see larger declines in employment rates over the last 2 decades, holding other things fixed. That's a summary. This chart is attempting to summarize that. So the evidence here is the first pass, but the available evidence so far suggests that the declines in fluidity on net are reducing employment rates principally among younger and less educated workers who are kind of on the margin of being in the labor force, being out of the labor force. They're the ones for whom the fluidity of the labor market is likely to be most important. Now, there's other evidence of that as well. I'll just show you one piece of evidence along these lines. This is somewhat different than the kind of evidence I've talked about before, but it's very much in the same spirit of this decline in fluidity, decline in business dynamism. So now instead of looking at just the business entry and exit rates, I'm looking at a particular kind of business expansion, and that's firms going public for the first time, initial public offerings. There's been an enormous contraction, a drop-off in initial public offerings after the 80s and 90s. Basically, it's quite clearly dated to around 2000 in this chart. That's the same time period, perhaps not coincidentally, in which you began to see a big drop-off in the worker reallocation rate. So to relate this to my earlier discussion, I pointed out earlier, there's been a big shift away in economic activity from younger firms. That's across all firms in the economy, publicly traded or privately held. This chart is telling you that there's been also a big drop-off in the rate at which existing firms are becoming publicly traded companies with publicly traded equity. Okay, so let me just pause there. I think I've given you enough material to think about, and I'm sure my colleague Kevin Murphy will have a lot more to add.
Yeah, I'm going to try to do a little bit on wage inequality, which is an area that I've done a lot of work in over the years, and just to kind of bring in a few things that kind of complement what Steve talked about, and hopefully we'll get back to link them up in some ways and talk about it. So I'm just going to go over a few basic facts on inequality. And when we tend to hear inequality, we typically think of income inequality, and in these days mostly talk about what's going on at the very high end of the income distribution. I'll come back to that later. But I'm going to focus on some more, I think, actually more central findings that we've been going on for a long time. And this is inequality of a type. It's measuring the wage differential between college and high school graduates. And this measures the premium that a college graduate has over a high school graduate, that's the red line, and the premium that a graduate school graduate has over a high school graduate, that's the green line. And it's covering the period 1963 to 2011. And there's a couple of things to note. One is there was the decline in generally the returns to education over the 70s, and that was, late 70s was, the bottom there is right about 1979. That's where Richard Freeman wrote the book, The Overeducated American, that talked about how Americans had become overeducated. Richard actually predicted that it would turn around after that, so he actually turned out to be right about that. But what's interesting, though, is the skyrocketing of the returns to education that happened in the subsequent decades, with both the return to a college degree and the wage differential for those with a graduate degree rising very, very rapidly over time. And so they essentially triple from their lows in the late 70s up to the recent period. Now, there's a couple ways to think about that. One is, one way to think about it is, God, it's really a rise in inequality because the college graduates already earn more. They used to earn 20-something% more. Now they earn 60-something% more, 70-something% more. And you can say, wow, that's a big rise in inequality. The other way to think about it is this big increase in return on investment. If you invest and you get a college degree, there's an opportunity. And as an economist, I really think it's important to think about these things partly at least as prices, and really mostly as prices. And so we have a rising price of schooling here, and that rising price of schooling is telling us something about what's going on in the economy. Now, if you take and you say, well, what if you tried to index those? That is, if you go back to the picture, how do I make these comparable? Have these gone up roughly the same amount? So a simple way to do it is to say, well, if one of them tripled, the other one ought to triple. And so you can make that kind of comparison. And that's what I did on the next chart. And you see it's actually very, very similar. They follow almost exactly the same pattern. That is, the return to schooling for college graduates and the graduate profile look pretty similar, although the 70s decline was actually quite different. The college premium fell a lot more over the 70s, which is consistent with some other evidence I'll come back again later. So again, this is all indexed with a base of 79, so the fact that this goes from 0 to 2 basically means it tripled. It went up by 200% relative to the return. Everything's indexed to 1979. We can also look within education levels. This is a graph of weekly earnings for men by percentiles of the wage distribution. Again, 10th percentile, 25th, 50th, 75th. These are in real terms. And again, you can see the expansion in inequality in this picture. Probably should have done it in logs. It's my colleague Bob Topel's fault. He put this chart together. Anyway, this is the same picture for women, and you can see a really rapid expansion. This is a nice picture. This measures from the same data the increase over a 40-year period in the real wage by percentile. So it measures how much did real wages rise. So for 20th percentile men, you can see that real wages went up very little, less than 10%. For the median man, they were up about 20%. For the high percentile men, they were up 60%. And these are all in log changes. For women, you get bigger changes at every percentile. Basically, women gained on men over the period rather substantially. So one dimension on which inequality shrunk was between men and women, a rather substantial decline in inequality between men and women. But this picture tells a nice story because it tells us there was an expansion in inequality throughout the distribution, right? That is, the 40th percentile did better than the 20th, and the 60th did better than the 40th, and the 80th did better than the 60th. So the whole distribution got stretched out. So that rise in inequality, it's not just about the various stories we heard over time. I mean, I remember early days, people used to talk about the underclass, that we had, everybody was doing okay except those guys at the bottom. They were really doing terrible, right? Now it's the super rich, right? And there's some truth to that timing, that the more the expansion at the low end was early and more the expansion at the top end is later. But the point is, if you look over the long period of time, there's been a fundamental widening of the income or wage distribution in the United States within gender, within both men and women, although narrowing between men and women, and a rise in those education differentials. So now you might ask, well, what about this 1% versus 99% story? So this is the Piketty and Saez data on the top one. This is the top 1/10 of 1%. This is how much of a premium they got over the average guy. And it used to be 20, and now it's 70. Okay? So it's about 2.5 times what it used to be. It's gone up by about 2.5 times what it used to be. Remember that college premium, how much did it go up? About a little over 2 times what it used to be. So actually, if you put this on a scale like we did with the college one, it looks like that. Now it turns out the college one ends up at about 2, and this one ends up at about 2.5. But they're not that far apart, even though this is a way up the income distribution. And the timing is almost the same. If you put them on the same picture, rescale the top one by 1.25, this is the picture you get. Seems like there's something going on here that's common across these different parts of the distribution. So I actually think this is an interesting picture. It sort of tells us that, the same time we started to see this real widening. Now, there's a big difference in the 70s. That's an interesting part. And that's going to tie into something I talk about later. So this is not a complete picture. We don't know all the answers yet. So this is a blank slide. That's a good one. So what generates what's going on? So go back to what I said before. What do I think about these pictures? What do I think about this picture? What do I think about that picture? My view of the world is pretty simple. I mean, I learned economics at Chicago. I only know one thing, supply and demand. So that's the way I look at the world. And I said, well, when I see prices falling, what does that mean? That means supply is growing faster than demand. That's why prices go down. Why do prices go up? Demand's growing faster than supply. Well, Larry Katz and I once wrote a paper about that for this exact market, and it turned out that fits the data pretty well. And I forgot to put the graph in this slide deck, but it turns out it actually works really well out of sample too. So it actually predicts very well. So thinking about the world with supply and demand is a pretty important way to think about the world. And it turns out that decline in the 70s is actually pretty easily explicable. It's actually explicable by the tremendous growth in the supply of college graduates that happened over the 70s, which happened not so much because so many people were going to school, but actually because we had a baby boom that hit the labor market that was much more educated than the cohorts that came before. I don't want to go into all the details, but it's a pretty interesting story. So that's the supply and demand story. So what's happened is we've had growth in the demand for skilled workers, way up the distribution, in the middle of the, upper end of the distribution, growing demand for skill that's outpaced the supply. So what generates growth in the demand for this kind of educated or skilled labor? Well, basically, it's the same forces that generate economic progress. So where does that growth come from? Well, there are 3 primary sources. Again, we learned this at Chicago. That is investment in physical capital, investments in technology, that is improvements in technology, investments in human capital, right? That's really the 3 pieces go on. We get new technology comes in, we implement that new technology with physical capital, with the classic story of capital deepening. Along with that, we bring in human capital investment, more human capital to build and utilize and create that new technology. These 3 are closely linked because the new forms of capital embody the new technology. Human capital creates, implements, and works with the technology. Technology capital, though, tends to substitute for less skilled labor and complement skilled labor. So the same forces that are causing us to grow over time are constantly pushing up the demand for skill. And so what you have over time is a race between growing demand for skill and growth in the supply. Now, over most of the 20th century, we increased skill supply fast enough to keep pace with demand. But what's happened in recent years is that balance has sort of fallen apart. That is, skills have grown more slowly relative to demand, partly maybe because demand's growing faster, but probably mostly because supply is growing slower. So why is that? Is it that people, so I'll skip this, we don't need all this. So this is a picture, oh, I don't want to show you that. This is a picture about how people, one question you might have is, well, do people respond? Do people respond to incentives? This is a picture of the same return to college I had before. It's actually a little noisier because it's measured for young people, but it's basically the same picture. On the left-hand side is a return to college measured on an annual basis, so per year. And on the right-hand side is the fraction of people going on to college of the young cohorts. Pretty amazing how closely those two track each other. That is, people do respond. What's even more amazing than that is that economists started talking about the rise in returns to schooling. We have a, or maybe I don't. I thought there would be a pointer on here. Maybe there's not. There should be. Nope. Anyway, about 85 or so is where people first started writing about the rise in returns to schooling, and people had already responded. That is, more people were already going to school. They knew before we did that the returns to schooling were up and more people were going on. So people clearly respond. But this is the fraction of people attending college. If you look at the fraction of people that actually complete college, it doesn't respond nearly as much. And I think that's a big part of the story. It tells us that, people respond to incentives. In fact, inequality to me, everything I've seen about the marketplace, it's not that markets aren't working. It's supply and demand has worked real well to explain what's going on. Suppliers are responding. They're just not doing a very good job of being able to get themselves through college. Completion rates have lagged, particularly for men. If you look for women, this is male versus female, fraction finishing school. This is at age 30, so you got to offset everything about 10 years here. So that peak, that bottom of that trough there is like in the early 90s. It's really back in the early 80s, so it's really back in the same picture. And in fact, if you want to go before they got to go 18, so you really got to go 12 years back. It just lines up perfectly with what we had before. But what you see is there's been a recovery for men and an acceleration for women in response to the higher returns. That is, that turning point there to the right corresponds to that shift in returns. But for men, we're barely above where we were before, even though the returns are much higher than they were back then. For women, we're above, and the women's trend have gone upward. Now, it's interesting, women's trends are like this around the world. That is, women improved in education relative to men around the world. In the US, part of it has to do with, I think, and the data seem pretty clear on this, that women are less prepared to go to college, are more prepared to go to college on average than men, particularly on the margin. That is, the marginal women going to college seem to be much better prepared. You can see it in their grades in high school. You can see it in how well they do as freshmen in college. The data are pretty clear that there's differential preparedness. So if you thought about the problem, well, if there's a problem on the supply side that we're not keeping pace on what you might think of as the extensive margin, that is the number of people going on to school, hasn't been sufficiently large to keep supply growing fast enough to keep returns from rising. But of course, the extensive margin isn't the only way you get more skilled labor. The other ways you can get more skilled labor is the guys who already have the skills can work harder, they can work more hours, they can do those things. And the guys who have less skills can work less hours and work less hard. Now, but the extensive and intensive margin act very differently on inequality, because the extensive margin, when more people go to school, that increases the supply of skilled workers, pushes down the wage of skilled workers, reduces the supply of less skilled workers, pushes up the wages of less skilled workers, reduces inequality. When supply responds on the intensive margin, it has the reverse effect on inequality, because while the prices go in that direction, the quantities go in the opposite direction. Each guy is working more at the high end and each guy is working less at the low end, it actually exacerbates inequality. And that's actually been pretty important. If you look over time, this is 70 to 72. This is hours worked per week as a fraction of what percentile of distribution you're in. This is for men. You can see how much steeper it's become over time. And that's the picture for women. That's how much steeper it's become over time. So you actually see pretty good evidence that this extensive versus intensive margin effect is going on. So one of the things that we've seen is we've seen growing inequality mostly driven by, at least on the education front, by a growing imbalance on this between supply and demand and on that side. That is, demand's growing. It's not that markets aren't clearing, it just means demand's growing faster than supply, which means prices are going to rise. But at the same time, we've had this intensive margin response where higher skilled workers are working harder, lower skilled workers are working less, and that's exacerbating the inequality response. So if you're thinking about where you have to go from here, I think you go back to where I started, which is you had that first chart, which is rising returns to schooling. It says a big return on investment. There's a value of investment. And the other charts tell us it's not just about schooling, it's just skills in general. There's a high return to becoming a more skilled worker. And to me, that's a signal that you want to respond. People are trying to respond, they just seem to be not very able. And I think part of that is because we have a lot of people who are poorly prepared, not just to go on in school, but poorly prepared to get the skills they need to be successful in the labor market. And you might say, well, is that a cause for policy? I mean, just you have bad things happen doesn't always mean policy has a role. But we got to remember, education is primarily a public endeavor. And the private sector is responding. People in the private sector, people are doing their part, they're trying. So we have to do what we can to try to do the public response needed, given we've taken that responsibility on. Maybe giving people more choice and other things would be a good way to go. But whatever it is, we need to respond to what the market is telling us, which is more demand for skills, both on the education and other fronts. So that's what I had to say.
Thank you so much, guys. Before jumping into it, given all the weather references earlier, I just want to say that as a UChicago alumnus, this kind of weather would signal the start of spring quarter for us. So DC is very weak when it comes to weather. I think it's great that you guys talked about employment on the one hand and inequality, because it's difficult to talk about either subject without the other. I want to start with you, Professor Davis, and put your research on fluidity in the context of the recent recovery and the current economic situation, because as you point out, that reduction in fluidity happened before the financial crisis. It's sort of a longer term trend. So I guess my question to you is, do you see that decline as having been exacerbated by the crisis and the recession? And do you see it more of as a structural issue that has to be addressed through kind of micro policies and policies that do away with the sort of red tape that you pointed out? Or is there a cyclical element to that lack of fluidity? Is there a demand element there that requires some kind of policy response on the macro level?
Thanks, Pedro. First, I just want to say I was very concerned about one thing Kevin said. He said he only knows one thing. I'm quite sure he knows more things than I do. So the logical inference is I know nothing. But hopefully there's some flaw in my logic there. On your question, the two fluidity measures I showed you, and if you look carefully at the chart and you know about business cycle conditions, you might have picked this out. One of them is quite cyclically sensitive and the other is not. The job reallocation rate, remember how it kind of just steady decline ever since the early 1990s, doesn't really move much with the cycle. So that measure of fluidity is fairly insensitive to the cycle. The other measure, the worker reallocation piece, and of course the churn piece, is quite cyclical. It's pro-cyclical. And you did see a very sharp drop-off in the churn piece of worker reallocation and the overall worker reallocation during the recent crisis and recession. And that probably exacerbated the negative effects of the secular decline in fluidity that I talked about. There's been a little bit of recovery of that recently. But we are still today, even after 5-6 years of kind of steady but slow recovery in the labor market, at levels of fluidity that are much lower than anything we had had in the previous 20 years.
And to follow up, do you therefore see this lack of fluidity as a central factor or the central factor in the U.S. unemployment problem, if you will, or is it, a kind of a minor factor that is part of a broader conglomerate?
Yeah, I think the jury is still out on that. This paper, there's really only one other paper out there before this paper that tries to look at the effects of fluidity on employment and unemployment. And that's a paper by Rob Scheimer. Both papers find evidence along the lines I suggested, but there's a lot more work to be done there. My best guess at this point is it is a factor, a non-trivial factor, but definitely not the dominant force behind the trends we've been talking about on the employment and unemployment side. It may have its most important effects, and this is not a question that I, or to my knowledge, others have looked at yet, on wage growth over the life cycle. So I emphasize the outcomes for employment, but if you think about the stories that I sketched out very briefly about how fluidity promotes the ability to progress along a career by finding what you're good at, by re-entering the labor force if and when you need to, by moving up a stepping stone type career ladder. All of those things are facilitated by fluidity, and we have a lot of evidence in the literature, some of the important work done by our colleague Bob Topel on this point, that job-to-job mobility facilitates wage growth and career advancement, especially for younger people. So the sluggish growth of real wages, which is another phenomenon you saw in Kevin's pictures, in the lower half of the wage distribution, that may also be to some extent tied to this decline in fluidity and some of the factors I talked about that are playing a role impeding fluidity.
And Professor Murphy, turning to the issue of inequality, not that I'm going to downplay the value of my UChicago education here in this contest, of course not. But I want to ask you some questions about the skills gap hypothesis and some of the developments that we've seen in inequality over the last, both in the near term post-crisis and as well as over the last 30 years. During the financial crisis, there was evidence or during the recession, there was evidence that unemployment rates, while they remained much lower for the highly educated than for the less, I don't like to call them less skilled, because anybody who's had a Walmart job or a cashier job knows it takes a lot of skill to do those kinds of jobs, but sort of lower paid skill jobs. There was evidence that the unemployment rates grew by the same proportion regardless of the education level. Doesn't that suggest that there's more at play here than just the return on investment to your college degree?
Well, I don't know. I mean, that's kind of changes in unemployment have always been cyclically more equal across education, for example, than they have been secularly. I mean, Bob Topel and I did something on that years ago, that cyclical movements in unemployment, while still unequal across education levels, tend to be closer to that proportional thing, even historically. So that's not as unique as you might think. That we saw that in the '82 recession. We saw that in the '90s. So when that tends to be more true cyclically in general. Now, it is true that if, and I didn't have time to go through it, over the period as a whole, there's this widening of education, of gaps across the spectrum. If you break it out by time period, in the early part of the period, say in the 70s it was much more at the bottom and less at the top. And then in the 80s, it was much more linear across the spectrum, and then it became more U-shaped. So it is true that the contrast is becoming further and further up the chain. So this view of early on, and that's true for employment too. So I mean, the wage and employment stories kind of, I think, line up pretty well. That, for example, in Steve's stuff, you see the some college group which the unemployment really kind of didn't do so badly for a long time, but they've done much worse recently. That fits very well with what's been going on with the wage story. That is the widening of inequality. They've been on the negative end as opposed to on the higher end as time's gone on. So there's been this, I think there's quite a bit of congruence there. So I think it is part of a supply and demand story, but it's a little more nuanced than the just high versus low. It's, you know, the growth in demand relative to supply, if you break it down by subperiods, has increasingly been a contrast between very high and the middle to bottom, whereas maybe earlier on it was top, middle versus bottom. So I think it actually fits together pretty well, although it is along the lines of what you've talked about. The other question I think it ties in, and I was going to ask Steve about this. I mean, we had rising durations. That was a big part of rising unemployment generally. If you sort of think about the churn decline, how much has the durations gone up relative to the churn decline? I mean, proportionate-wise. I mean, like, is the churn out of unemployment gone up less or more than the churn between employment? Probably more.
I haven't looked at that directly. There was a very pronounced drop in unemployment exit rates.
Yes.
Okay, unlike anything we've seen, certainly going back to, as far as the data go, to World War II in the United States. So there's no prior episode that looks quite like this one does. Even if you go back to the early 1980s, which was almost as severe a downturn, you saw a much faster recovery of the economy, but you didn't see this extended period of very long unemployment durations.
So before getting, I want to get into what you guys see going ahead, because I'm sure the audience is very much interested in that. But sticking to the issue of inequality, what about the notion that if you look at the way that productivity gains were distributed between workers and corporations, that you see a divide sort of in the late 70s, early 80s, where there are estimates that if the minimum wage had kept up with productivity gains, that it would be around $20 an hour today. Do you see any credence in that notion, given the rise in executive and banker pay and so on? Do you think that has any impact?
Do I think the minimum wage is the story?
No, do you think that that a lack of pay growth at the bottom and a runaway pay growth at the top, do you think that is part of the story beyond education?
Well, I think it's very much driven by the same phenomena. I think that you talked about less skilled versus more skilled. It's really about abundance versus not abundance. A lot of people can do, might be hard, but if a lot of people can do it, they're going to get that much command that much money.
Let me give you a very specific example. So I cover the Federal Reserve, right? And the Federal Reserve is composed of economists and bankers and so on. Now, the range of wealth in the Federal Reserve goes from about $350,000 for a regional Fed president who shall remain nameless, to up to $130 million for Jerome Powell, who was a former private equity guy. So you can't argue that there's a skill gap between Fed officials, presumably.
No,
right?
It's not the skill. I mean, well, part of it is a skill gap, and part of it is a skill gap in terms of what's valued in the marketplace. But I think a lot of the story, I told 3 pieces, and it was actually on my slide, but I didn't say it, which is markets, the size of the market, and as markets have grown, that's another source of growth. We've gotten a lot better because markets have gotten a lot better, but markets are also a contributor toward inequality, and I think a lot of this is. If I'm in a market where I can command an enormous amount of resources, this is the old Sherwin-Rosen superstar story, that's clearly playing a big role, I think, in driving inequality, and driving inequalities, particularly as you move further up the distribution toward the very top. So, you know, if you just think about if you start a business, if you go to the very high income earners, where are they getting their money? Most of them are either entrepreneurs, where in today's improved capital market, if I come up with a good idea and a good business, I can get high quality workers, high quality capital, funding, and expand that business very rapidly today, much better than I could in the past. That's going to contribute to inequality. You know, I think that's a big part of the story. Now, the other place where you can get a lot of capital real quick is financial markets, where you can leverage very quickly, and if you're a little bit better, you know, how many extra basis points you got to make a day in order to like become a multimillionaire? Not that many.
Yeah, fair enough.
Half a basis point or so.
So moving on to the, to the specific subject matter that we're here to talk about, the current state of the economy and the labor market. We're starting a new year with, again, optimistic forecasts about the U.S. economy. The Fed sees the economy growing somewhere close to 3% this year, and there's the expectation that it may raise rates as early as the middle of the year. But there have been disappointments before, and the primary headwind currently seems to be fears about growth overseas. We have plunging oil prices that reflect in part supply, but also in part fears about demand. I'm wondering where you guys see this year headed,
Macroeconomists here.
You know, I'm not asking you for point forecasts because I know you guys aren't. You know, you're not Wall Street types. But do you believe in this recovery, and do you think that we are resilient enough to kind of decouple from the globe at this point?
Well, let me say a few things. I mean, there's a few favorable things in the United States relative to where we were, say, 18 months ago. One is we seem to have got past this period of dysfunctional policymaking in D.C. where, think about the debt ceiling, the fiscal cliff, the dispute over the government shutdown. These are all episodes of, shots in the foot inflicted by the political system that accentuated what was already a weak economic environment. So I think one, and I don't sense in D.C. now, maybe somebody here can tell me otherwise, that there's a continued appetite for that kind of behavior among federal policymakers. So I think that's a plus. Second plus is we see in the U.S. continuing evidence of not just improving labor markets, but maybe improving a bit more rapidly than they had been, okay? We're still a long ways from where we were before the crisis in terms of employment rates, labor force participation rates. Part of that difference is demographics, people moving across the retirement threshold. But we're still way behind where we were, but you're asking me about kind of looking ahead. So on the US side, there are considerable reasons for more elevated optimism than, say, we would have had a year ago. Looking abroad, there's still good reasons to be worried. The Eurozone remains a mess, really. They have structural problems that are long-standing. They've layered onto that. This may be not PC at the IMF. They've layered onto that the common currency, which shuts off some of the macroeconomic safety valves that in the past countries like Spain, Greece, and Italy would have availed themselves of to mitigate the harmful consequences of their structural problems. Those things continue. I don't think the Eurozone has quite figured out how to handle the constraints it's placed on itself. We have renewed concern about Greece. I've thought for a while it might make more sense for Greece to exit the euro at least temporarily, but doing that without causing disruption is a difficulty. There's also uncertainty related to both oil prices and geopolitical tensions in Central Europe with respect to Russia. There's been some slowdown in China's economy. I think that's likely to persist. That was a big source of demand growth in much of the world, so that's probably going to be muted. One bright point is our colleague Raghu Rajan seems to be having some favorable effects in India. That's a big country as well, so we wish him well there. And so I think when you look beyond the U.S., you can certainly find reasons to be concerned, and you can certainly tell stories where things might unwind in a very unfavorable way.
I guess I would add a couple of things one is the oil price story. Obviously, we're still net importers of oil, so on net we'll probably benefit from lower oil prices, but the adjustment side of that's going to go the other way. We've invested a lot, not just in the oil industry, but other industries accommodating the oil industry. The rail industry has changed dramatically the way it operates and other things because of the way the oil industry is operating. We're going to see some of those regional shifts going back the other way from where they've gone in the past, and we know in the past is a short-run drag because you got to move resources from here to there, and that value gain for moving them, we don't count in output. The other side I think worries me is some of the stuff Steve talked about earlier. You know, when you have those depressed employment rates, it doesn't just mean that you have fewer people working, you have fewer people gaining the job market skills, and particularly when they're out for long periods of time, we know that that's detrimental to their long-run labor market prospects, which isn't going to show up in the next year, but it's going to be a drag years to come. And you know, that worries me a lot. That worries me that you've had people who've now been out of work for long periods of time. We know it's hard to get them back in, and certainly get them back into the kind of jobs. And if Steve's right, the dynamism is down at the same time, that's going to become even harder to get those guys back to where they can be as productive as they otherwise would have. So it means we're accumulating some capital losses that we're not counting on the books.
Can I just add something to that? And it's back to the long-term trends that came up in both Kevin's prepared remarks and mine, but I think affects the forward-looking output, not so much over the next 1 or 2 years, but over the next 5 years. You know, Kevin put it gently, but he suggested towards the end of his remarks that our schooling system has failed to some extent to adequately respond to the demand and supply shifts that he emphasized in his discussion. I thoroughly agree with that. The good news is there's a lot, the US is well inside the frontier in terms of school quality, maybe not at the collegiate level, but at the primary and secondary level. So that there's upside possibilities there, but that's a very slow working process to make those reforms and then to see the benefits of those reforms. So I see us now having inherited a legacy of an inadequate schooling system for some time to come. That's one kind of headwind against a long time to come, right. And I think the fluidity factors that I emphasized in the stories I alluded to briefly is accentuating that, because if you don't get the kinds of skills to prepare you to perform well in the labor market before you get there through the schooling system, then you want to try to get them while you're in the labor market. And one way to put a key theme of my remarks is that part of the human capital development process has also been lagging. So it's not just the schooling. So we are inheriting that kind of underperformance of our human capital development process, both on the schooling side and in the labor market, and we're going to carry that forward for a long time to come, even if we fix things now.
So given that grim assessment, do you think there's a lack of urgency when it comes to tackling these kinds of problems, given that even though they on an academic level, there are long-term problems to the people suffering the sort of brunt of them, they seem like very urgent problems, whether it's unemployment or bad schooling, et cetera? Is there a lack of urgency?
You know, I think there's a lot of inertia in those kinds of systems, and we've had them for a long time. I think we've known we've had problems, and like Steve, I mean, Steve really put it right, because you think about it, if I could fix the schooling system today for people entering as kindergartners and make it perfect today, those people don't come in the labor market for 16, 17 years if they go to college, and then they don't become half the labor force for 35 years. I mean, we're talking long, long time there. And if you're not also doing it on the job, it's very tough. Now, the good news is you don't have to fix it everywhere, because as you improve skills, that shifts the supply and demand balance, which helps even the guys you haven't improved their skills, because there's then less low-skilled workers competing with them, pushes up wages at the low end for them. So, and this gets back to this whole story. I mean, one of the things that happens is, particularly among those low-skilled workers, when wages decline, those people drop out of the labor market, much more though than the high-skilled workers. If labor supply is not a straight line; it's very curved. It's very much more elastic at the low-wage side than it is at the high-wage side, which again, that inequality plays into this declining employment rates. I mean, you see it in the hours figures that we had up on the board.
Well, in the spirit of Chicago academic debate, I'd like to turn it to the audience for questions, and please keep them. There's a mic up there if you guys want to go up, please, and please keep them fairly short. Otherwise, I'll make the executive call to cut you off. Sir?
Hello. My question is regarding the quality of life for Americans in the last century. I foresee that it has gone down for probably maybe the bottom 90, maybe not for the top 10, but that's my perception. And maybe you can validate that. And my question is, at what point in time will real wages actually exceed the cost of living increases again? Because I think that, to a certain degree, is separating, adding to the inequality of incomes as well. Thank you.
I think it's an interesting question. I mean, I'm not so sure I would put the price index stuff as adding to the inequality of incomes. I think a very instructive thing, and you can do this with your students if you teach, is go get a Sears catalog from like 1975 and ask them how much stuff in there they want to buy at those prices. I mean, at the price, if you get zero inflation, you can buy at the prices that are in the catalog today. There are not many things. You wouldn't want the TV, you wouldn't want the camera, you wouldn't want the sofa, you wouldn't want just about anything in that catalog at those prices. And you know, what's amazing to me is just how much prices have also diverged between different, like what your kids pay for jeans versus what a low-income family's household would pay for a pair of jeans, and the gap, how that gap has changed over time as well. So I think it's a really interesting phenomenon. And you know, obviously picking manufactured goods is kind of taking the low-hanging fruit because they're clearly real wages measured by manufactured goods have gone up. On the other hand, if you were sick, you really want them to drive you to the 1970s hospital? I don't think so. Even if I had to pay the bill, I'm going to today's hospital. So there are not that many places where I would choose to go. I don't know what you think, Steve.
Yeah, I largely agree with that. For most, let me add two things. So I basically endorse what Kevin said about that. One thing I think we forget about that, and I've been struck by this traveling around the world, and especially countries where you see lots more poor people. People of limited means, and there are many of these folks in the United States who don't have kind of great things to look forward to in their lives, place an enormous value on entertainment of reasonable high quality and variety. And I remember walking around Hong Kong, you see a little street vendor there, and they got this little produce stand that's, you know, about the distance from me to Kevin. This is how the person's making their livelihood. You can see by looking at them, they've had a rough life. What have they got there? They've got a little color TV there, and they're watching it anytime they're not doing a transaction. And you get in a conversation with them, and you know, it's like, this is like 3 months worth of income, but they want that color TV. Why? Because it's entertainment. And you see there's been a tremendous spread of inexpensive entertainment that is highly valued by people who main alternative use might be sitting on their sofa, walking their dog, or just hanging out in the street corner. That's not very well captured in our price indexes. It is something valuable to people. It's kind of different than the examples that Kevin gave. So I wouldn't underestimate just the value of fun things to do with your time for people who otherwise wouldn't be able to access much of that. And that's been an enormous shift in the economy. Just think about all those channels on your cable TV. Now, you may not like many of them, but somebody likes them, and somebody's getting value out of watching them.
I guess I worry about inequality in a different way. And one of the things that's very important for those people also, though, is the ability to invest in their children and have their children do better than they do. And you know, when we live in a world in which getting the skills is so much more important than, you know, we've always had lots of poorly educated people, and we always had lots of lousy schools. There just were lots more things for poorly educated and people who went to lousy schools to do in the past than there are today. So that existing disadvantage, I think, is really exacerbated today. And I really worry about kids growing up in communities even like where I grew up, who, you know, today's world maybe have a harder time getting out.
Yeah, I think that's right. And it's not the kind of thing that shows up on our standard GDP statistics, but there are many communities in the United States where just your average, you're walking around the street, at home, it's kind of miserable. There are dysfunctional families, you don't feel safe on the street. I don't know whether that's gotten worse. Maybe it hasn't gotten worse on the crime side. Some statistics about families headed by single parents suggest it has gotten worse within the household. And that's an aspect of well-being that is quite important, but doesn't show up in most of our standard economic measures.
Thank you very much for both, Professor, your beautiful and excellent lecture. But my question is that, as you see, there is a dichotomy between college education and the real, workplace skills. So, do you recommend that United States would develop those apprenticeship program, like what the Germany or Netherlands was doing, to have Volkswagen or other manufacturer companies directly, get into the universities to teach the students how to make a car or parts or contractual skills or something like that to connect the industry with the education? If so, how do you think like the financial servicing industry, which require a lot of soft human skills or networks, to get into those kind of apprenticeship to teach the students to directly connect with the current industry? And on the sideline, I just wonder, Professor Davis, did you do a kind of research regarding of the different industry sectors, their fluidity about their job allocation? Thank you.
Would we import the German vocational model into the United States? Is that a feasible option?
I'm not sure we can import it wholesale, but I do think there is tremendous room for schools, and I guess we're talking about high schools here in particular, to expose kids to a range of skills they might develop that could be useful in the labor market. And it's not everybody learns effectively in the classroom. Some people learn by doing things in a hands-on manner, which you kind of associate more with apprenticeship or work-study type programs. In many schools, we don't provide much of that opportunity. So my view is basically we ought to try a variety of approaches. We ought to recognize that the right approach probably differs across students. It differs across communities. It doesn't make any sense to have this kind of vocational training in a location where there isn't really that kind of vocational job opportunities for people, or at least it certainly makes less sense. So more of that, yes. But I don't think we're going to move to a system where we adopt the German approach wholesale, because that involves a set of relationships between employers and schools that we're not going to create overnight. We might create them incrementally. So I'm basically sympathetic to that, but
yeah,
Kevin.
I guess I would say a couple of things. One is, in most of the work that I've done, I've emphasized education as kind of the dimension of skills. And the question is why? Because it's easy to measure. Because, we can actually just ask somebody how many years of schooling you have. The thing you have to remember is education doesn't actually explain that much of wage differences across people. That is, there's much more variation in earnings within education levels than there is between education levels. I mean, R squared of education is like 0.2 or something like that. I mean, there's just so much more variation within education. So most of the skills out there in the labor market are not things that are really just all about schooling. They're differences that people with the same level of schooling have, and it's just they're harder to measure. And we've seen, and the signal I take from the marketplace is that the value of a lot of things have gone up. That is, the difference between the guys that have a lot and the guys that have a little more valuable than it used to be. And that's true across the board. And and the question is well, what response have we seen? Well, we see the private sector responding. We see, a lot of efforts, for example, to come up with new innovative ways for people to get a college education, whether it's online. The thing about these kind of things, they're probably not going to be very successful early on. That is, people are going to try things, they're not going to work, and the question is how long is it going to take us to experiment to find something that does work?
And on the second part of her question, is, does the financial sector have a proactive role to play in any way, or do you think it has to come from industry itself and then the financing part comes later?
No, there are for-profit educational companies out there, and they need financing, and some of them seek financing from the financial sector. So there's a role for both to play.
I would say the most important thing is not public versus private funding, or that it's competition. I think you really, that's why does the education work for people who live in the suburbs? I mean, it works pretty well because there's competition. People vote with their feet and they'll go someplace else. Why it doesn't work for guys on the south side of Chicago? Well, there's no competition much. There's a little bit from Catholic schools and things like that. But, we actually have a decent education system for people where there's competition. And there's competition in the secondary, in the higher education. And we have a great higher education system. We have more competition there than most places, and that's one of the reasons we do so well, even though a lot of it's public. So, I really think competition is the key.
Just one second, I'm going to go over here. There's two mics, so I'll give you a chance shortly.
Thank you. I had a question regarding your discussion of people responding to price signals on their increased return to education. And I wondered if you see evidence about the effect of government support for higher education in distorting those price signals and also distorting the allocation of what people choose to study and go into. And then secondarily, in the United States, we're unique in the sense that people pay a great deal directly for their higher education, whereas in most countries, what they pay directly for is the cost of time, and that the monetary cost of that education comes across large periods of time in transfer of taxation. And whether anybody has really in the United States looked at the response to people to price signals outside of the United States in a completely different system.
Yeah, so in terms of, interesting, one thing that you do see is that prices responded. That is, the supply of education isn't perfectly elastic. So if I did like tuitions in both public and private and tied them back to returns, they would look very similar to returns. Tuitions were increased very slowly in the 70s when returns were falling, and then started going up very rapidly. They basically track returns very closely. So you do see prices. Does the government distort price signals? Absolutely. We have a very public system. It's kind of like our healthcare system. It's not really a market system. Now, place we have closest to a market system would be in higher education, although there's still lots of price distortions there. Although I think that's one of the reasons why we're such a big exporter of education. We have a very good higher education system. It's not so feasible to export elementary and secondary. I don't think we'd be very successful in that market if it existed. But there's less reason to see that.
Go ahead, please.
I have a question about entrepreneurship and innovation. I have an MBA from Columbia, so I'm a guest here tonight. When I went to my reunion last year, they told us that the 3 hottest areas that the young graduates were going into were Wall Street, obviously, management consulting, obviously, but entrepreneurship, which had equal play with these other 2 areas. And we've seen the rise of these incubators at major business schools across the country. Georgetown has one called Hoyapreneurs. Johns Hopkins has the Carey School of Business Innovate program. And this notion that you could create an entrepreneurial ecosystem which greatly increases the chance of success of these entrepreneurs. You bring to bear the right resources, whether it be access to venture capitalists, angel investors, intellectual property lawyers. And do you think that this trend is going to sort of jumpstart the innovation, job creation, et cetera, in the US, or do you think it's sort of a passing fad?
I'd be interesting to tie that into the fluidity question, because on the one hand, we have had improved capital markets and other things, although it's not clear what that does to fluidity, because it may mean that greater resources flow to just the best opportunities. I don't know. Have you thought about that?
Well, let me make a few comments. We see the same thing at Chicago. There's been a growth in demand for entrepreneurship type courses over time at Chicago, as there has been at many other schools. And I think that's great that business schools are imparting these skills. They are focused on certain kinds of entrepreneurial businesses. They're not usually the labor-intensive, like, do I want to open another restaurant type business? A family-owned restaurant. I think to some extent we have to recognize, though, that there are big rewards to successfully creating a firm, but that may go hand in hand. That doesn't mean that there aren't policy-induced barriers. So I'm not an expert on this, but many people have argued that Sarbanes-Oxley and the disclosure requirements associated with public firms is one of the reasons why the IPO rate dropped off. So part of what we teach our MBA students, I think, is how to operate in a rather complex legal and financial environment. And some of those complexities arise organically out of the functioning of the economic system. Some of them are a function of policy that are maybe somewhat ill-advised. But by and large, I think it's great that business schools are doing this, but that's just a part of what we might think of as entrepreneurship. It might be a very important part, but it's not the part that creates a lot of employment at the middle and low end of the
churn,
probably or a lot of churn either. Okay, so it's an important part of entrepreneurship, business formation, business entry, but it's just a slice of it.
So what happens when you got, instead of starting a new independent restaurant, you're now opening a Jimmy John's or Five Guys or whatever?
Well,
right? I mean, it's an established model.
And it's related to something you said earlier. You gave a different example, but I met a few months ago with a guy, I can't remember what the name of his chain was, as a franchise, and he told me his business model, and he used to work for Burger King. He started out on his own about 10 years ago. He now has 500 franchised operations with a kind of a two-level distribution. He gets 6% of the gross revenues off each one of these franchise, 500 of them. 2 or 3% of that goes back to his regional managers. So you think about this, and each one of these operations are several $100,000 in gross revenues a year, maybe 7-figure gross revenues a year. So it's a perfect example of something Kevin said earlier. This is an organizational form, these franchise arrangements, that has grown up over time, partly as a consequence of technological changes, partly as a consequence of a legal environment that facilitates them, that allows a guy who a generation or two ago, he might have been running 5 of these or 10 of these by himself. And now, instead of having a bunch of 50 guys who each are running 5 or 10 of these, the guy who's the best, the most ambitious, the hardest working, the most entrepreneurial, he's running 500 of them. What does that do to the skill distribution? Well, it spreads it, what does that do to the wage distribution? It spreads it out enormously. The guys who are running these franchise shops, they're making a decent living, they're supporting a family, but they got one guy here who's getting really rich, to put it mildly, using a business model that has developed over time and contributes to rising inequality. It's also got many positive effects. It means the guy who's got the best idea for running the competitor to Subway is now able to scale his activity much more broadly than he could in the past. So this is the kind of superstar effect Kevin referred to. It doesn't just operate, for professional athletes or professional musicians, but it operates at this much lower level.
And then how does it affect fluidity? It might reduce it. I mean, that's
it could.
Because if you have all those guys running 5, I mean, they're going to be churning in and out.
There's this effort now to make a rather serious shift in the current legal regime governing employer-employee relations for franchise. I'm talking about this lawsuit against McDonald's, which wants to make McDonald's kind of put them in the role of the employer for all these franchisers. Now, I think that will reduce fluidity if that's successful, big time.
Let's get to the next questions because we just got 3 more and we're running out of time, so go ahead.
I think this is already partially addressed by the 2 questions ago, but you had talked, Professor Murphy had talked about a return on investment from education, but how much of those return has been sort of taken from the universities through increasing real prices? The sort of cost of education you kind of hear at least in the media, students graduating saddled with debt that they may not be able to pay back over time.
I haven't done the calculations for a while. When I had done them before, like a quarter maybe, something like that, that they didn't take most of it. Most of it still ended up with the guys making the investment. I mean, tuitions went up, but not nearly enough to soak up all that extra return. I haven't done the calculations in a while. That was probably a decade ago. But that was kind of the rough and ready things I had seen.
If you guys could both ask your questions since we're running out of time, and then we'll
yeah, it's a great honor to meet Professor Davis and Professor Murphy at the same time, so I'll ask my question really quick. The first is that a lot of people have already asked question about the response about education, so I was wondering, according to your research, what is the possible research as a public endeavor, a governmental response in education area? And the second question is, there is a contentious debate about the economic policy uncertainty slowed down the recovery from financial crisis. And you also mentioned that one of the reasons of reduced fluidity in the labor market can be policy developments. So I was wondering, maybe there's a two-sided causality between financial crisis and the economic policy uncertainty. Maybe the financial crisis also increased the uncertainty in economic policy.
Go ahead, please.
Thank you. And thank you again so much for being with us tonight. It's been a lot of fun. Early in Professor Davis's presentation, we saw a slide on creation and destruction of jobs, and I've always thought of creative destruction as fundamental to how capitalism works. Periodicals, and I'm thinking particularly of The Economist recently, have put a lot of thought into the rate of creation and the rate of destruction, specifically with regard to automation. We haven't talked about automation's effect on the low skill level of the job market this evening, and I was hoping both of you could comment on how big a factor or driver of the future job market automation is going to be in your perspective.
Okay.
So want to take the automation?
I wanted to address two things that came up there, which is what's true on both the fluidity story and on the inequality story is that the policy approaches are tough in a sense because in both cases, the forces driving it are both positive forces and have a negative consequence at the same time. It's like when I talked about growth and the demand for skill. I mean, the same forces that are pushing economy forward, which is new technologies and more physical capital and all those things. One way to slow down inequality growth would be to slow that stuff down, but that'd be a horrible idea. Just like when Steve talked about fluidity, a lot of the reasons why you have less fluidity are actually good events where you actually have improved productivity. So I think that view that you have both positives and negatives. And now, in terms of policy uncertainty, I mean, Steve and I both done some stuff. Steve done more than I have on policy uncertainty. To me, one of the important points to always remember with policy uncertainty is it has its worst effects when it's going to be resolved. Because that's when people really have an incentive to wait. If I told you it was uncertain, you wouldn't know the answer for 10 years, you'd probably go ahead and pick something and do it. But if I tell you you're going to know in a year or 6 months which way you should go, it has a much bigger effect.
Sounds like Fed policy every day.
Yeah. Go ahead. I mean.
Yeah. On the policy uncertainty, I'll just make one point, and this is what I understood the speaker to be saying, and I agree with it. There is some evidence that in the wake of major financial crises, for example, or could be other kinds of crises, that one of the amplification mechanisms of the economic effects is it creates a lot of uncertainty about what policymakers will do. And at least in democratic societies, they feel compelled to do something, even if they don't know what might be helpful. And I think that is probably something in the wake of the recent financial crisis that accentuated its prolonged negative effects beyond the types of mechanisms, the balance sheet type effects and so on, that economists are more likely to emphasize. I think there's an interplay between disaster happens to the economic system. That leads to a flurry of activity by policymakers, much of which is not very well thought out. And then the uncertainty as this process is unfolding is another reason, and this is Kevin's point, This is in a period of intensified uncertainty that gets resolved maybe after a year or two, but in that period of intensified uncertainty, you don't want to make big investments. You don't want to do a lot of hiring. You don't want to move to another location to see if things are better there, because you want to just wait, see where the dust settles, then make your moves.
Yeah, particularly in this, I mean, if we had more time, we could try to tie it in on both the other sides, because this ties into your earlier point that in a world in which there are more frictions and more difficulties of getting rid of people if you turn out you don't need them, that interacts and then makes that incentive to wait even greater. And then tying into the human capital side makes the consequences even greater, because you have those people sitting idle while they're waiting. Somebody mentioned automation. I mean, technological change in general is a huge driver of what we're got. And it's not just the direct effects; it's the indirect effects that has on physical capital investment and other things. So I do think automation is going to be a driver. And originally, we automated out the very low skilled. We've increasingly been able to automate out higher and higher skill, and I think that's part of the reason why that contrast picture has become more and more convex over time. It was very concave originally, because mostly we were affecting the very low relative to everybody else, and then became more linear. Now it's become very convex, because technology really, the guys we really haven't been able to get is the guy who has the 500, he's been helped by the technology to this point. Someday a computer will figure out how to do that, and then he'll be out too.
There are now Excel macros that will write news stories on command, and it's pretty scary for my profession.
You're in trouble.
We'll leave it at that. We're out of time. Thank you guys for the questions. Thank you, Professors Davis and Murphy. Really appreciate it.
Thank you very much.